most of the time dealing with topics of energy trading, and especially the transition of energy trading and risk management towards systems with high shares of renewable energies, which is probably what we will be talking about today. On top of that, I do some research in the area of digitization of the energy system. So everything that is labeled with a buzzword smart, smart energy, smart meters, stuff like that. So that's my second topic of research and teaching. And I'm happy to be here, and looking forward to the webinar and to the discussion.
You forgot smart grids, Alexander.
Sorry, smart grids.
Just kidding. And you maybe interesting for the audience. You wrote a book, right? I bought it. It's like when people are watching Netflix at night, I'm scrolling through your book and tapping into the vast knowledge you shared about energy trading. It's very interesting, and I think a good intro for maybe people that have not worked for ages in trading and risk, because I mean the domain is under big change related to the energy transition, right? It's something you mentioned. We have much more renewable energy coming online. Can you maybe share a couple of thoughts on how that changes the structure and the dynamics of maybe the energy markets as we knew them a couple of years ago?
Yes, absolutely. So, the thing is, we could actually have a 2-hour discussion just about this shift. So I will try to be pretty brief about that. So one thing that isn't fully clear to most people who deal with energy trading and stuff like that is that renewable energy sources differ fundamentally from conventional energy sources, such as coal power plants, gas-fired power plants, and so on. Because what we usually have, if we deal with energy trading, we need some energy price. And the price is usually set by supply and demand in all liberalized markets. And supply comes at a cost. So what is relevant for pricing and energy markets is the marginal generation cost of the power plants that currently provide the electricity. And traditionally, this was a linear curve. So with cheap generation at the very lower end, that was usually nuclear power plants, and then going up to coal, gas-fired power plants, and so on and so forth. And at the highest prices were from oil, basically oil-fired power plants. Now with renewable energy sources, this has changed fundamentally because the generation cost, the marginal generation cost of renewables is zero. So we now have a supply of energy with marginal cost of zero in some hours, and some hours we don't. So this makes it quite a lot more difficult to estimate prices, and by that to apply sophisticated trading strategies. And the second point that comes with that is not that only that we have energy supply at zero marginal cost, but also that this supply changes over time. So with traditional energy sources such as coal power plants, those could be online 24/7, 365 days a year, and you could actually estimate the prices and the supply on the electricity supply quite easily for the next even months or years. Now with renewables, this is totally changing because the wind doesn't blow the same every day, not even every hour. The sun doesn't shine at night, and during day. Today I look outside, it's a bit cloudy, so there's probably not that much PV feed in. So the supply also changes over time, changing the supply curve, the merit order all the time. And this has a fundamental effect on energy trading because like 10 years ago, energy trades were basically done on a long time scale. So you could actually purchase your energy 1, 2, 3 years in advance, and then you're happy with it because you knew how the merit order, the supply curve would look in a couple of days and a couple of years, and you were done. With renewables, this is totally changing because it changes every day, every hour. If there's a lot of PV feed in during the day, then the prices during the day will be very low because there's very much a huge amount of feed in from energy sources with zero generation costs. If the next day it's cloudy, prices will be higher. And this is a fundamental change, and it comes with PV and especially wind as well, because you can't estimate the wind feed-in precisely for more than a couple of days in advance. So this makes pricing, trading, and risk management, well, very sophisticated, because modeling future prices has become difficult, and you have to adjust your trading strategies, well, every day or even every hour, because if you own these generation plants, well, you don't know how much they will generate 2 hours from now, 3 hours from now, precisely. So you have to buy, sell energy on an hourly basis. So this general change,
Yeah, and I think what you mentioned, you have indeed the traders, but I mean, a trader usually knows the concept of marginal pricing and merit order curves. But what we see in the market is that, a bunch of whole new people that didn't know these concepts or didn't need to know these concepts. Think about just energy sourcing managers or just companies that were very used to hedging their energy demand, as you said, years before on a percentage basis of their demand, not even with stable base loads, but like they are exposed to so much more complexity in today's market. Like, do you see that as well, or what do you think the primary challenges are for companies, utilities, and large consumers of energy in today's and tomorrow's market?
Yes, absolutely. I couldn't agree more. I mean, as you said, like 10 years ago, so you would just buy a contract, a full supply contract, where you could get your energy at a fixed price for a couple of months in advance. Now, this is still possible today, but especially if you have your own generation on site, like if you own PV on your roof, which is pretty typical now, even in mid or on Northern Europe, then the PV plants, they generate energy, but the thing is they don't generate it constantly. So what you usually have is what we call an open position. So the open position is always the difference between the energy that you bought and the energy that you consume. And in a normal contract, this open position is always zero. But if you have your own generation and you have an oversupply of energy, you somehow have to get rid of it. Or if you rely on your own generation, you have to buy the difference between your own generation and what you actually need. And this makes the whole energy management strategy a lot more complex, and many people aren't aware of that. So one other example is what is very popular instrument nowadays are PPAs, power purchase agreements. So this is where you basically simplified that you buy the power generated, for instance, from a wind park. Now, what most people don't know is that, well, they know it, but they somehow don't take it so much into account, is that this power isn't the same all day. So even if you buy 20 megawatt hours of this power, you don't know when it comes. And power now is something different than power in an hour, or power in 2 hours, and power in 3 hours. So you have like a volatile power supply, so to speak. But you probably, if you have some kind of manufacturing or so, you need a constant power, and you have to somehow manage the difference between what you bought and what you actually need. And this is referred to as the open position. And most people who are new in this business are not fully aware of that. Mm-hmm. And that's actually a big challenge for managing, and especially for risk management in these areas.
Yeah, we even saw some companies that, they were used to the percentage hedging 3 years in advance, and they would just continue doing that, but with a fixed base load. So imagine now I already secured a 10 megawatt base load for 2027, but then suddenly the next month, someone else in their company secures a PPA that comes online in 2 years. And then you run the risk indeed of being severely over-hedged, and then these mechanisms which basically used to reduce the exposure are basically increasing again your exposure, or this open position as you call it, which is indeed it's heavily underestimated. So for those people that are working in a company and that are basically bound to their utility that they contracted on the different sites, and some own generation in the shape of solar maybe, what do you consider these days some best practices, or what should they start looking into to ensure really a better or a future-proof risk management? That's to come back to the title of the webinar, that's good for the age of renewables.
Yes, well, they're basically two extremes at both sides. So the one side is, the question is, how much risk are you willing to take on yourself, and how much do you want to pass on to somebody else? So if you take the whole risk to yourself, then you definitely need a lot of experienced people in your company. You need manpower. And on top of that, you need, operational systems that are actually able to deal with that, because keeping the risk that you just said, the overhedging, so securing more energy than you need, is also a risk, because when it comes into delivery, meaning when the power from the PPA comes, you have to get rid of it. You're obliged to, which means you have to sell it. And this sales signal can come maybe 2 hours before generation, 1 hour before generation. And if that is at 3 o'clock in the morning, you need somebody sitting there at 1 o'clock doing the trading. And most utilities, or many or companies, probably don't want that and don't have that. So if you actually are willing to take the risk by yourself, you need to be able to manage it in real time. And this is probably more than most companies are willing to do. So on the other side of the scale, you can just sell your risk to a professional trading institution, which can be a large utility or professional companies that do the trading for yourself, and then just sell them all the risk, and they will do the management of the open position online for you. On the other hand, of course, this comes at a price. So the question is always, how much risk are you willing to take? So at the very first step, I would always suggest to get an understanding of how much risk is actually in your purchase portfolio. And you might need professional assistance for that. And once you realize how much risk that is, and in energy markets, this risk can easily become millions. This can be millions per year. And once you're aware of the risk, then you have to think, how much of this risk am I willing to take by myself? How much am I willing to pass on? And then it's just a question of, you will take risks. And that is a strategic question. But I would always suggest, first of all, become aware of the risk, make a brief estimation how much it can be, and then consider selling it to somebody else, to a professional trader.
Yeah,
that's what I was always suggesting. Yes.
Maybe adding a bit of the Companion.energy angle. What we see as a potential too is, okay, you can sell part of the open position, of course, and trade it on the market. That's a very good option. What we see some companies developing as well is what they refer to as demand side flexibility. So they try to add some more flexibility in their way of consumption, for instance, with buffers or with batteries, or sometimes they scale down the solar or the wind production they have on site based on this open position and based on the pricing signals they get. Can it be seen as an alternative to this trading, or does it work hand in hand? How do you see that topic?
Well, it can be. Well, the question of demand side flexibility, actually, from a fundamental perspective, it's not such a big issue, because demand side flexibility basically is the same as supply side flexibility. So it doesn't change if you decrease demand or increase generation. It's the same. But what's very interesting about this topic is that the more and more demand side capacities that are available in the market, the higher are the opportunities to trade with them, as you just mentioned. Yeah. However, the big challenge there, I believe, is that most demand side capacities are pretty small compared to generation capacities. So the typical demand side flexibility, as you just said, might be batteries that you have somewhere, or also electric charging. But these capacities are pretty small, so it may not make sense for a company to market their flexibilities, their demand side flexibilities on their own, but rather give them to some aggregator who is able to, again, manage this open position for them, because, well, the transaction costs that you have, that I just mentioned, you have to be there 24/7, you need the operational processes and so forth. These are pretty high compared to the capacities that you have. So the question is always, do you want to do it by yourself, or do you want somebody else doing it for you? And again, the first step is assess your risks, assess the opportunities, think of the cost, and then decide by yourself. But the challenges are high, but still, the more and more demand-side capacities we have in the market, the more and more opportunities there are, obviously.
Yeah. Interesting. And then you can indeed trade them. We see some just doing a bit of reactive arbitrage, I would say. The companies that have some day-ahead price exposure, they can save a few percentage here and there on the energy cost if they just reactively use this capacity that they have. Maybe, talking about, you mentioned the utility industrial company or utility company relationship a few times. Do you see this relationship changing these days? Like the contracts, do they start differing? I guess we talked about the price formula that goes for sort of all the risk of the utility. Now you have more this conscious choice of, do I take the risk myself or do I pay the premium to someone else to take it? Do you see other differences in the market these days?
I actually do. And the interesting thing about this is not the main reason for that, I believe, is not the increasing share of renewables. It's actually the war in Ukraine in 2022. So all of you who were already in the energy business realized the huge price increases in 2022 following the attack on Russia. And by that, many utilities, many large energy suppliers became aware of not only the big ones, but also the small ones, became actually aware of the price risk that is actually inherent in their portfolios and in their contracts. So in the years before, prices didn't change a lot, but then suddenly they changed dramatically. And what we could see from there is that many of these utilities are trying to give away their own risk and shift it towards their customers. In other words, large companies, large energy consumers, because they were not willing to take all of the risk, even for a high risk premium. Even for that, many of them are not willing to take that risk anymore. So they try to get rid of these, so to speak, all-inclusive contracts and shift price risk more towards the consumers who now have to actually get some knowledge about energy markets, who have to build up some kind of energy portfolio management, even get their own trading departments, because they have to, because nobody gives them all-inclusive contracts anymore.
They're forced into it, but I think there's also a good thing to it in the sense that it increases also awareness with the complexity that is inherent to the energy market, which is, I mean, if we're talking about the energy transition, I think it's a good thing that way more people start being knowledgeable about it and building the skills to navigate this. Alexander, we got some questions in the chat. Let's maybe take a look. Annelies asked the question: does the financial cost risk of over-hedging versus under-hedging differ? Meaning, is there a higher risk or financial cost to sell back positions that you have versus buying additional volumes?
Yeah, that's a question of the price distribution. So the question, very good question. Most people aren't aware of that there is also a cost of overhedging. So if the price development is symmetric, meaning that very high prices have the same likelihood as very low prices, then the risk doesn't change. Then it doesn't change whether we have the risk of selling something at a very low price or buying something at a very high price. So if they are symmetrical, then they don't. However, what we see in energy markets is that the distribution is not symmetrical, so it is more likely to have very high prices compared to very low prices. So I don't take this as a general statement, but depending on your portfolio, you could say that overhedging might be a bit cheaper But again, it depends. It strongly depends on especially on the time of the day, because these price distributions, they change during the day. So you might have very low prices at night, during the day. During the day, during the night, you might rather see very high prices. But this depends, and this is actually a really complex technical issue, and there's no general answer to that, I'm afraid.
We should maybe have added a disclaimer like this is not concrete trading advice before people start taking
absolutely.
Huge positions based on what you just said.
Absolutely.
Second question is from Dimitri. He asked about if you look at forwards or futures, the different cal products, you see, well, it's always been the case historically that you see a bit of a declining trend because, I mean, of course, if you add some more years, you can build generation capacity. So the price usually has a downward trend, but it's a good question. He says there's some moderate inflation going on. There's expecting CO2 prices that are on the rise. Do you think the dynamic will shift of having the call 28 lower than the 27, lower than the 26, lower than the 25?
That's the question my students constantly ask me. And I constantly answered them, if I knew how that will develop, I wouldn't need to be sitting here teaching all of you. I would be sitting on a beach somewhere with a cocktail in my hand. And so unfortunately, I don't know the future. What I do know is that the forward prices you can see at the markets right now are the best estimation that we have. So if you think you know more than the current market prices, then you are you have a very high then you're sort of then maybe you should consider trading, but always keep in mind that the market prices you see right now are the result of all market participants put together. So the current decline that we see in the forward price curve, I agree, is interesting. So it's going down at the long end of the curve. It's going down, but you always have to consider how these prices are made, and they're basically made by expectations. So the forward price for Cal 2027, for instance, is the expected spot price, average spot price in 2027 from today's perspective. And this expectation contains a lot of information. It contains information about CO2 prices, inflation, as you just said, but also fuel costs. So costs for coal, gas. It also takes into consideration the expected feed-in from renewables, and all that together comes at a market price. So yes, there is inflation. Yes, CO2 prices will probably go up, but maybe this is overcompensated, or not maybe, but right now, the market participants expect this to be overcompensated, probably by decreasing fuel prices and probably by increasing generation from renewables. But if you know more than we do in the market, you're a very lucky guy. Do your trading and make some money out of it, and send me pictures from you at the beach with a cocktail in your hand.
Okay, cool. Maybe a small tip as well, like usually the year plus 4 products are over the counter available with utilities, but of course there's other forwards like much farther in the future that are that also can be traded on the market. So there's maybe some additional price information available for some of you. New question from Annelies. Risk exposure is also defined by a portfolio of own generation assets. What's the ideal portfolio of assets or trading strategy to accommodate the volume and price risks in high renewable energy source scenarios? So I guess we're talking here about mixing a bit solar with wind to get a bit of a balanced portfolio of renewable energy sources. How do you see these different tactics?
That's again a pretty challenging question. So this I believe depends on your own strategy and on your own willing to take risks. So if you only have fluctuating energy sources in your portfolio, then you have a very high price risk and a very high volume risk. Volume risk because you don't know when the feed-in comes. Price risk, you don't know what the prices will be in these hours. And if you want to reduce this volume risk and consequently the price risk and the risk exposure, the total risk exposure, you have to find a strategy to decrease the open position in these particular hours. And the best strategy to do that is to get either flexible generation. So this can be, I don't know, gas-fired generation or biomass fuel generation. But there are also contracts available to deal with that. So you can have some sort of virtual power plants. You can have some kind of virtual generation, which is equivalent to the physical generation to manage this open position. But another strategy can be to sell this fluctuating generation via a PPA, for instance, and by that get rid of the risk exposure. But I don't think there is an ideal strategy to deal with it. From my perspective, the first issue is always to be aware of the risk that you have, then make an estimate how high this risk exposure is, and then look at different strategies to decrease it. Flexible generation, or doing trading, or selling this risk to somebody else. But this strongly depends on your power plants, on your renewables, and also on your willing to take risk.
Yeah. Another technique that we often see is when you have a really big industrial conglomerate with multiple sites, for instance, in Germany, is that you pool the risk across you do the variance pooling across different sites and sort of aggregate some production, some demand. It makes it easier to manage those risks. Yvan asks a question on the sub-markets. I think also, for instance, capacity or balancing markets. There's of course differing liquidity, differing depth, breadth of those markets. But in those markets, you have some arbitrage opportunities. What do you think about the liquidity of the different markets, how it will evolve, as well as the arbitrage opportunities? Because then we're also at the hour, and Annelies immediately asks as well, like, is it better to hedge on the futures market and sort of get a lower price, or bet on the day ahead versus intraday market? So it's all about, where is the liquidity? Where are the biggest arbitrage opportunities? Where do you see that balance going?
Okay, first of all, let's start with the second part of the question. Makes it a bit easier. So the question again is, how much risk are you willing to take? If you need base power Cal 2025, for instance, then the best strategy to reduce your risk is by buying this contract on the futures market right now. When the closer you get into delivery, the higher is your risk. And if you just buy on the day ahead or even intraday markets, then you have the highest risk. But risk always comes with opportunity. So that's actually a strategic decision again that you have to make. I'm not so sure if it's possible to make arbitrage on these markets. Actually, there are some arbitrage opportunities on the futures markets. On intraday and day ahead markets, there are arbitrage opportunities, but only if you have a sophisticated portfolio, for instance, containing batteries or generation and demand or flexible generation. That's possible. On futures markets, the only arbitrage opportunities I see is between products, but these are all taken by auto traders, by algo traders. So I see that quite difficult. But what we can see is that actually trading volumes are shifting more and more towards the short-term markets. So day ahead intraday markets and also balancing power markets. This has an interesting effect on balancing power markets because balancing power prices used to be pretty high all over Europe. And we can see during the past years that they are pretty much declining. In Germany, they're actually close to zero. In other countries, I know they're a bit higher, but this depends on the specific country. If you want to make arbitrage on intraday markets versus balancing power markets, for instance, be careful because usually this is, if not illegal, then not really legal. Because balancing power markets...
The TSOs don't like it, of course.
Yes, they don't like it. Maybe if you do it, maybe in the first time, maybe they find it funny, but the second or the third time probably use your grid connection. So be careful with that. Look at the legislation. Balancing power markets are there to stabilize the grid, Whereas on intraday, on a day-ahead markets, you can trade as much as you like. But if you don't have any physical assets, it's pretty different. It's pretty difficult to actually make money out of arbitrage.
Yeah. Yeah. Okay. Great. Alexander, we blasted through our 30 minutes. It was very interesting. Sorry to hear your thoughts and get your insights on this. It's quite a pertinent topic for many during the energy transition. I want to thank you on behalf of us, Companion.energy, and also on the participants. We will for sure be open to more questions via LinkedIn, via email. Everybody can contact us. We'll also publish the recording of this webinar. So I'm sure the interaction will keep flowing a bit, even when we're out of the time now. Thanks a lot, Alexander, and we'll see you another time.
Yes, thanks again. Interesting discussion, and thanks a lot for having me. And yeah, I'm also looking forward to any comments and ongoing discussions via any channel that's available.